So the number one myth that passive investors go through, they look at the property, they look at the market, the business plan, but they don't look at the property manager,
Mm.
the actual person who's going to make your dream a reality. They don't look at the leasing agent. They don't look at the regional.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Kunal Dewan is an engineer by education, an entrepreneur by choice, and a real estate investor by passion. Kunal, welcome to the show.
Thank you. Excited to be here, Sam.
Absolutely. The pleasure is mine. Kunal, there are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start, where are you now, and how did you get there?
I started in Southern California almost 20 years ago uh, with a condo, with a small condo. And the journey since then, in the last 2 decades, with my engineering background, construction background, slowly scaling up to duplex, to triplex, to fourplex, to small multifamily, to syndications. And here right now in my journey, I am going towards a vertically integrated firm so that we can take down larger assets and create passive income cash flow for our investors.
Wow. Oh, that's really, really cool. So let's hear what type of assets are you buying right now then?
Multifamily. I only do multifamily, Sam. I have been doing multifamily. I understand multifamily. I'm competent in multifamily. About 13 years of my life, I used to be a structural engineer in my previous life.
Hmm.
So I used to build, design and build tall building skyscrapers, residential, and then went to hospitals and then to mixed use and then to multifamily. And then that's when I say, you know what, this is what I want to do for the rest of my life. So I only focus on multifamily.
I love it. I love the focus. Have you ever dabbled in any other asset classes, or has it always just strictly been multifamily?
I started looking into self-storage for a little bit, and and I'm glad I did. So I looked into self-storage in my extended friend circle. I have friends and extended family who invest in hotels.
Mhm.
And so I looked into that. There are car washes in their extended family. But I'm so glad I learned about all this so that I know I don't want to do that. So it kind of just helped me further go deep in what I do already.
Right.
So
Would
that's why I only do multifamily, because I don't want to do any of those.
It sounds like you have found the power of focus to be part of your success strategy. Can you speak to that?
Indeed, I don't do multitasking. I hate multitasking. I'm a strong believer of one thing and just one thing at a time and just do really, really good. So it applies to be it time with the family, be it business, be it um, anything else. Now, I'm guilty. That's not how I used to be, because I started with a W-2 job. I'm a first generation immigrant, right? I mean, I started with $400 20 years ago. I had to build something while I was doing my job. So that was my engineering, and I did my residential real estate 18 years ago. And then after that, I built my first business, and I started that with $2,500 to multiple 7 figures, multiple unit while I was doing my job. So that was the time when I was realizing, my early 20s, I can rule the world, I can do everything, only to realize, no, you gotta go deep if you want to build up. So going back to engineering, the foundation has to be wide, it has to be deep, so that the structure above can be as high as you want it to be. So when I quit my W-2, I went all in on my business, my first business. Then I went all in on my residential portfolio and started making that a passive investment. So my business is fully passive, great team. I have a team of 20 plus people, they manage it. My residential portfolio, I have great people, handyman managers manage that. And now I'm going all in my real estate syndications. I have done 4 syndications in the last 12 months,
Wow.
and there are 2 in the pipeline right now as we speak. So, and this is all I do right now. So the power of focus is so valuable if you want to go long and far and truly create impact. I can talk about the same in my personal life, but I think you get the point. One thing and just one thing at a
One
time.
thing and just one thing, man. And I wish I had met you about 5 years ago and you could have given me that speech then, because that has been the theme of, somebody asked me this in December, and it's like, I look back at everything we've done to this point and I'm like, it's all going very well, but is it as great as it could be if we focused and just stayed in one thing? And somebody said, hey, what are you doing in 2023 to make it more meaningful? And I said, it's going to be focus and team. Like, we are just focusing. So I love that. I love the way you've said that, one thing and one thing alone. And that can be hard to do, to turn off, especially with the, for the entrepreneurs in our midst like you. I can imagine that the temptation to look elsewhere, because there's always good opportunities coming our way and it's tough to say no. But I love where you're saying there on focus. Let's talk about the 3 myths of passive investing. I know we mentioned this here off air, but would love to get your insights on what that means.
Yeah. So, when I started into real estate syndications, where now I'm going outside my own personal equity and creating equity for other investors around me, friends, family, neighbors, coworkers, and then their circle, they don't have the real estate, I call it burnout, that I went through. They don't have the scars and the wounds that I went through as a landlord. And real estate syndications have gained popularity in the last few years. I mean, less than a decade, right? So, and now I live in Southern California, and the entry level the bar is pretty high. And
Yeah.
plus there's regulation and lots of red tape. So we start looking to outside California to invest. And the questions coming up, okay, yeah, 80,000 a door, 100,000 a door, great business plan, fantastic, all good stuff. And that's all they stopped. The passive investors stopped their DD at that level. So the number one myth that passive investors go through, they look at the property, they look at the market, the business plan, but they don't look at the property manager, the actual person who's going to make your dream a reality. They don't look at the leasing agent. They don't look at the regional, So that was the reason that I'm going into a vertically integrated firm, because now in our company, in our partnership, we know the leasing agent.
Right.
We know the handyman and the cousin who are doing the job. There's a relationship. So the gap between the business plan and the execution, the risk gap, is very small because we have the control. So I encourage all passive investors. There's nothing wrong in getting a third-party property manager. But look at the track record of the property manager. Look at the challenges of that property management business right now in that market.
Right.
Look at the failures and success, right? So that's my number one. Number two is, we talk about data a lot. Look at the data, look at the data. That's great. And we look at the gateway markets, like LA, Southern California, great market to invest. It has lots of troubles, but so you have the market, you have the data. I call it the selective data, the data that kind of feeds your buy box. But they don't look at the big picture. And in this picture, where does the sponsor fit in? Right? So you are a sponsor. Your market back of your hand, Sam, right? And you have the data for that market. I would encourage, if I was your passive investor, I will ask you, hey, in your market, what are the bad points? Give me the data for the bad points. So people think if I invest in gateway markets, my investment is secure. Nothing can be farther from the truth, because who is more important than what and where?
Yeah.
So that's the number 2 myth. And the third one, my favorite, and a lot of people cannot get their head wrapped around this. And this is coming from my construction background and my value add projects when I did for myself, is I call it the too much value add. Every neighborhood has a cap, okay? Depending on the income, depending on demographics, depending on so many different factors, job and employers. There's a cap. There's a cap on the rent. There's cap on the even the house price people are buying. right? So people think, okay, I'm going to remove the plywood. I'm going to remove the countertops and put some granite. There you go. That's $80. I'm going to remove the carpet, put some laminate flooring or tile flooring. That's another $80 in rent. And they keep on tacking on this, and they keep on calculating the extra revenue that product will generate.
Right.
Well, if you look at the graph from a mathematical perspective, the amount spent and the return received, right? That graph, let's say there's a $250 rent gap between a great product and a product that you are buying. That graph has a really high growth in the beginning of the renovation. The first $5,000 you'll spend, you will get instant $80, $100, $150 rent bump, which is great.
Sure.
But the last 5,000 you will spend, whatever that is, be it an extra countertop or a Wi-Fi package, a security pack, whatever that is, the return on that last is not the same as the first.
Right.
So people kind of tend to average it out. Okay, there you go. That's my average in increase in rent by the money spent in CapEx. But that's not the way to do this, because the last bottom 20%, 40%, that value add is not necessary.
Mm-hmm.
It's not necessary because you're past the market. So look at the value add plan, look at the market, look at the comps, the true comps. I am a passive investor myself where I invest with other people. You know what I do, Sam?
What's that?
I call the market. I call the market myself before I spend my another 100 or 250K as a passive investor. I ask, okay, what are the amenities? And there's like a trash valet, and then there's a pet fee. I get all of that. Now I know this is my spectrum. This is the bare minimum rent, and these are all the extra things happening based on certain amenities and the finishes. Then I come back to my product. Where am I? And then I do my math myself. And then I come up with the sufficient value add, and I look at the too much value add, and then I make the decision. So that's my number 3 myth that every passive investor should consider before sending that money to the sponsor.
I love it. I love it. That's a great, very simple to understand, but great points you made there on, the 3 myths that of passive investing. But let's talk about this too much value add, maybe a little bit more in detail. When you say that, is this subjective, as in you say, okay, each property is going to have its own version of too much value add? Or are there things that you see kind of across the board that sponsors are doing, such as, I don't know, the things you mentioned there, Wi-Fi packages, security cameras, et cetera, that just aren't getting that same return on investment that other things like flooring and countertops might? Or is it, again, to the beginning question, is it a subjective thing where it's a property by property basis?
Yeah, so great question. The easy answer is it's half art and half science.
Okay.
And the way to look at it is, let's say you have 2 exactly same properties, literally on each one side of the street, right? Facing each other, exact same unit count, mix, yada, 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 right? And assuming the demographics do not change between the 40-foot wide street, right? Because demographics can change drastically, especially in big markets where you at, where we at. So assuming all that, right? Now you look at a small 1-mile radius. It's a long answer to your short question, but I really want to give some insight the way I look at.
Please.
You look at a 1-mile radius. Don't go too far, just 1 mile. And you can get the income and the demographics, and even sometimes the number of people from depending how far you are from the census in that neighborhood, right? Then you go 3 mile, then you go 5 miles. So if you can draw these, circles based on this income, whatever your cap is, my cap is 33%. 33% is my maximum rent a family would pay, right? So I backtrack. This is my maximum spendable money on the rent or other expenses, plus minus 2 to 3%, including amenities. So let's say if the income is $100,000, that's $33,000 plus minus 2, 3, let's say 36, that's $3,000 a month. So I'm talking here in Southern California, right? I invest quite a lot in Central Coast in California. So let's say it's $100,000. $36,000 is my total spendable money when it comes to rent and related expenses. So $3,000 a month. These 2 properties, This property is renting at, let's say, $2,900 with some basic finishes. My property has older finishes, and I can bump it up with some flooring and some countertops, some nice paint to $3,100, right? I'm already ahead of my underwriting and the market.
Yeah.
Anything over is not going to create a huge return without compromising my economic vacancy or physical vacancy, provided the income in my 1 mile radius, the math that I did, is changing. So I look back 5 years or 10 years. If the income is changing, the growth in the income is high enough, then I'll build this in my value add plan. But if the income is growing at 2%, 5%, well, I'm going to build my disposable income to similar number. So maybe $20, $30. Why would I spend, taking down the walls and adding a loft size a living room and a $30,000 capex expense when I'm only going to get $1,500 extra? Right. That's what I meant by extra value. So look at these numbers at a very molecular level, because real estate is not local. It's ultra local. So look at all that and then make the decision. What's my right value? So I draw a spectrum: bare minimum value add, desired value add, and too much value add. So in every business plan of mine, I have a spectrum. So when we present that to our investors, we go with the desired value plan. Many times we don't even have to do that because the rent growth is sufficient or our execution is efficient.
I love that. And so even in your deal decks, you will put out there the 1, 2, 3. What'd you call that? The minimum desired and too much.
I do only 2 and 3. So we actually, to the lender, we talk about everything so we can have the capex budget ready if we need it. Sure. But internally, so we do 2 underwriting. One underwriting is internal that I do myself, where I know, okay, this will yield here. But too much data sometimes can blindside investors. Yeah. So I kind of just pick one. This is the plan based on this. These are returns. And we know anything over is just cherry on top.
Right. Right. Oh, that's really, really cool. I like the way you think through that. I've not quite heard that clear of an explanation of value add. I mean, you hear that term, but the too much value add idea and how to quantify and qualify what that is. Tell me about what you guys are buying in the multifamily space right now and how that has changed over the last 12 months.
Oh, great question, Sam. We can talk about another hour on just on this topic. A lot has changed. In last 12 months, the debt was cheaper. So it's a whole lot easier to execute. Right now, we all know what the seller is asking and what actually made sense. The gap has widened drastically. I mean, I was reading a report just a few weeks ago. I think the volume is down overall nationally. There was a report by Marcus Millichap. It's down by like 70% or more. That's a lot. So what we are buying right now, our fundamentals have not changed. 12 months ago, the last deal I did, I had a reserve of almost 7% of the equity raised. And this lender required. This was our reserve because we knew where the market is going, and we're still sitting on that equity right now. And I'm actually kind of moved that to a CD just as a backup. So we knew what was coming. We always have that reserves, but now the market has changing. The volume has gone down. The type of assets are coming up online. It's hard to make numbers work, but when it works, it is a super sweet deal. So the asset we are looking right now, the offer is tomorrow as we speak. The going in cap is in high 6s, and the treasuries have dropped in last few days. So the debt we are getting in sub 5s, mid 5s. So we are already in positive leverage right there, and the rents are lower. I don't know the inside details, but I feel that the seller might not be able to execute his business plan, so he doesn't want to get out, which creates fantastic buying opportunities.
Right.
So what we're looking right now is beautiful, fantastic buying opportunities if we don't deviate from our buy box, the investment thesis.
Right. Right. Yeah. That's and that I guess that's the well, maybe we can talk about the types of debt you're taking on, and then I want to hear what that buy box is and why.
Another one of my favorite topics, agency debt, strictly agency debt. We're not doing any bridge, anything like that. Fixed. My first syndication, first investment. This was late 2020s, early 2021, when the bridge was like 2.5 or less than 3.
Right.
Even then, I did a fixed debt, and because I believe in it's a long-term play. We are in a long-term game. I'm not talking 2 or 3 years. Even to my investors, my average hold is 5 and 7 years. We're talking cash flowing as long as we live.
Right.
If we exit, we exit, but our goal is to actually refinance and not sell. So the type of debt we're getting is strictly agency debt, buy box. The buy box is my box. Buy box cannot be the same as your buy box or anybody else, because
Sure.
my buy box is through the lenses of the risks that I can take. And it's different than yours.
Right.
And the risk that I can take, I'm not talking aggressive, I'm talking on the lower end, because this is not my money. With all my money, I can do whatever I want. I can buy whatever car I want. But somebody's putting the money on me. Oh my God, I'm going to take it to the next level. So I have these extra layers. My underwriting, I have taken the templates from over the years, and I have modified. I've written my own macros and I've written my own spreadsheets. So I can see the spectrum of risks every time I send an LOI. I know at this purchase price, what will be my risk? And at this purchase price, what are my risks? And the same thing with the business plan. So that buy box and investment thesis is different for every person depending on their personal situation. Mine, number one, is cash flow. I'm a believer that if the property cash flow within year 1 and the debt is stable, you can ride out any downturn, because the horizon is when I die. So because we are planning a long-term wealth generation. This is not. So cash flow mitigates that. So even like right now, the deal that we're going to do this week, the LOI going at tomorrow, our first year cash flow is in high 6s. Now that's just first year. As the operations improve, the NOI improve, profit improve, it's just going to go up. So down the line, 5 years, 7 years, we're going to refinance it and then hold it for eternity and keep churning the cash flow. So that's my number one buy box criteria, cash flow. And the second is right now in today's market is I'm not going for deep value adds. I'm going for stable and just increase it by effective operations using our vertically integrated team.
Those two things sound very sound. Sound policy and procedure. I like the way you think through both of those items. Kunal, this has been a blast having you come on the show today. I've learned so much from you, just in the way that you guys approach assets, your 3 investor or passive investor myths. We've learned about your kind of journey in the real estate space. So many things here to take home and consider. I think the third point there on the too much value add, I think that was the one that was really cool. It was how you calculate what too much value add is. So present us with a lot of things to think about here today. Certainly appreciate you taking the time to come on the show today. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
LinkedIn. LinkedIn is the best way to reach out to me.
Fantastic. We'll make sure we get a link to that there in the show notes. And again, thank you again for coming on today. This was a blast.
It's a pleasure, man. Thank you for having me, Sam.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen. If you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.